Hi, everybody. Warm welcome and also a happy festive season out there to everybody. This is going to be the last of our Landlord Webinar Series, and hopefully you are excited and get some really good information from today's webinar. We're just going to give another couple of minutes for people to join, and then we're going to start in just about a minute. And as always, there's always going to be time for some Q&As at the end of the webinar. And please feel free to raise some questions over the questions function any point during the webinar as well, so we can answer them in the end. For the new people joining, don't worry, we haven't started yet. Just going to be another minute before we start. Yeah. Again, warm welcome to everybody. And again, welcome to our last webinar in our Landlord Webinar Series, which is the Landlord's Blueprint for a Lasting Legacy. So joining us today will be myself, I'm the head of Fusion Financial, and Henry, who is the senior tax advisor over at Fusion Tax. Well, we're actually going to keep it quite interactive as well, just to, first of all, give you an overview of some of the planning points that we encounter a lot, in terms of planning on the tax and financial side for our landlord clients. And again, all the innovative financial solutions that we do to help you protect yourself, your families, and your business. So as a general introduction for the agenda today, we'll just kind of briefly, as always, introduce this, the webinar and what's, again, any follow-up actions, and then also just dive straight in. Pension planning for landlords, property tax structuring. We're going to talk a bit about protection planning as well for landlords, and at the end, leaving the best for last, succession and inheritance tax, which is probably the most popular topic we always get asked by our landlord clients. As always, as a thank you for attending the webinars, we're always offering you a complimentary consultation with our 360-degree team, right? So, most professionals, landlords have more than, one professional area of concern. With our meeting, again, you just get to have multiple professionals from different specialisms talk to you all at once, so you can have a much better 360-degree angle to tackle your problems in terms of the business and in terms of the family side of things. Fusion, again, we're a multidisciplinary firm covering all aspects of professional services, tax, accountancy, financial services, legal, and as well as recruitment. So let's go straight in terms of pension planning for landlords. So to cover some basic information in terms of pension, right? I think, in terms of the very, very basics, as in, again, pensions are tax-free, fully tax-free. So money that you do put into your pension will not be liable for any corporation tax. Money that you put in after you've already paid tax, you can claim tax back. And then once the money is inside the pension, right, there will be no more tax due while it's growing or receiving any income from within the pension. So what does that mean for landlords? It means that registered pension schemes, first of all, do not pay tax on any rental income or capital gains on any property holdings that you get. You can also invest via pension into property, including land, both in the UK and overseas. Now, one thing you have to be very careful about is investing in residential property because, again, HMRC puts very, very defined and strict rules on not holding any residential property directly, but I will go into some details later on about ways you can potentially invest into residential properties via your pension scheme. Also, in the end, just putting in there that transactions with connected parties are allowed, but you do have to be careful with following some certain defined rules. So that actually means that, for example, you can use your pensions to invest into properties that you own, right, or your company owns, but you just, again, have to satisfy certain sort of rules so you don't breach the HMRC regulations and then incur a very punitive penalty charge, really called an unauthorized payment charge. So again, covering the first of all types of pension there are and what kind of investments that's permitted within those types of pensions. Now, most people, if you're employed or if you are self-employed but have a auto-enrollment pension, for example, that your accountant has set up, you would have a personal or an occupational pension scheme. So these are sort of the most common and most basic types of pension schemes. Now, what does that mean for landlords and how can you invest into property type investments within? So there's two major asset classes you can do in terms of real estate. First of all, you have your property funds, and they could be commercial property funds, they could be residential property fund, they could be industrial property funds. And this is very much a passive sort of income stream because you're asking, a professional fund manager that buys, manages, and sells the properties on your behalf. There's nothing for you to do, right? You pay the fund manager an annual fee, and that's it. The other type of fund structure is called the real estate investment trust, which if you hold on a personal basis, there's some certain tax advantages. But if you hold in a pension, within your pension, there is actually no tax regardless. So again, it's just another type of property fund that you can be investing in within your pension. So broadly speaking, right, these two types of investments have the same tax consequence within the pension scheme itself. And then move on into the self-invested personal pension, a SIPP, which a lot of landlords probably know about, right, and have set up themselves. But also be careful, there's actually two types of self-invested personal pension schemes. One that is essentially like an extension of a personal pension, whereby you can only invest into traditional, stocks and shares, cash, property funds, real estate investment trusts, for example, but you can't really invest in the crucial third bit, which is listed here on the slide, which is commercial property. Now, if you want to invest directly into commercial property, you need to open up what's called a pure SIPP, whereby the SIPP provider will have a trustee system, and they can actually look at your commercial property purchase and then make the necessary signatures, authorizations, so that you can actually complete on that commercial property purchase within that pension. Now, one of the very popular platforms, Hargreaves Lansdown, for example, they're just very much a investment SIPP. You cannot purchase a commercial property within there. If you do want to, use the SIPP as a route to purchase commercial property, you have to look at, again, certain more specialist SIPP providers who actually have the capability to do so. So again, this means that you can, within your pension, and remember, money that you've accumulated in your pension is fully tax-free. You can now buy commercial property and you can rent it out either to a third party and thereby collecting rent, which gets paid tax-free into your pension, or you can actually rent it out to yourself. So you may have a business yourself and offices that you do operate, or perhaps a warehouse where you store things. And your business will then pay rent to your own pension scheme. So on the one hand, you've got tax relief from as a business expense, paying rent. On the other hand, you receive the rent fully tax-free. It's a double whammy, tax-efficient way to operate if you have your own business and you require a commercial space that you have for the business. Now venturing into the sort of what I call the shebang of the pension schemes, which is the small self-administered scheme. So this is where you can be really flexible and can invest in a much wider variety of assets, especially property. So not only can you purchase directly commercial real estate, as with the same with the SIPP, you can also do what's very interesting, something called a loanback. Now, this is where, one of the tips and tricks are where you can actually indirectly hold residential property. Because what a loanback means is that you can actually loan, you can loan back a certain amount, right, which is up to 50% of the value of your pensions, to the sponsoring employer. So the company that's actually paying the pension contributions, which is usually your own business, your own limited company. What you can then do is that, right, I dictate that, okay, my pension is now given my business £100,000, and there is no restrictions at all how you can hold that £100,000. So you can then use that £100,000 within your business to then actually potentially invest into a residential property. It doesn't have to be, it could be anything you want, as long as you are paying a commercial interest, right, which doesn't have to be above commercial, but it has to be a certain amount of interest payable. And you have to repay the full loan within 5 years. So 5 years is usually the cutoff date for how long you can actually have that loan. Thirdly, you get, on a fifth types of asset you can actually invest in is a joint venture. So what that means is actually if you have either friends or actually just people in your network who you want to invest into their business with, and that could be property related, like a property development, right? That a friend of a friend or a cousin, or again somebody exciting in the property industry is looking for. You don't have any personal money to actually invest into them yourself, but you can actually, using a SaaS, own shares of that private company that does the development of the property. So essentially that means that if, for example, Henry, right, has an exciting development that he's doing, right, he's refurbishing a big, he's actually refurbishing a really cool property somewhere in London, and then he's raising some money, right? I can actually invest via my small self-administered pension scheme into Henry's business, essentially. And kind of like is a good segue into the next asset, which is a development finance. So as many professional animals will know, right, is you're raising money, right, people will always be interested if you pay them a certain interest rate. Similarly, you can facilitate this type of loans to other people. So not only can you loan back to your own, via your pension, to your own business, right, where can you develop your own properties, you can loan money to other companies and help them with their property development journey and receive an interest, which is tax-free in the pension, as a reward. So covered a lot in here. So I'm going to slightly stop speaking for now, and then, moving on to some of the tax bits. Over to Henry.
Yeah, thank you, Chenji, and hello to everyone who's joined us today. Just brief introduction from my side. So I'm Henry, Senior Tax Advisor here at Fusion, also Chartered UK Tax Advisor. So I feel when you talk about property, invariably you end up talking about tax, because as everyone knows who invests in property, right from cradle to grave, from your very first property deal, dealing with stamp duty, all the way to the end when dealing with inheritance tax, you invariably come across tax. And for some people, a lot of people, particularly watching, tax is one of those issues that we've seen a lot recently with, especially since George Osborne back in 2015, making a lot of changes to the landscape. And we're going to talk a bit about ownership structures. So to begin with, when we, as Chenji alluded to earlier, some of the ways you can structure a property deal can make a difference, specifically from a tax perspective, because how the income usually is distributed is how the property is usually taxed. So there's a couple of ownership structures here we're going to talk about, and perhaps maybe ones you haven't considered before, but maybe are looking to consider, or maybe it's something that you already know about and you're looking to perhaps investigate further with your tax advisor or your accountant. So the first one we're going to talk about today is joint ownership between spouses. So this is probably the easiest one, and from my experience, this encapsulates probably more than 50% of landlords, where you're, generally speaking, you're in a civil partnership or a marriage with someone else, and what happens is you are owned, you're looking to buy a property. So in my example, I've just done some rough figures here just to give an illustrative, try to give some examples behind what I'm trying to explain. But if you're looking to buy in a joint, so there's two different types of legal ownership in England and Wales. So there's joint tenants, which for most people, the vast majority, in fact, of spouses buy in joint ownership, which means that effectively you are 50% owners, although it's slightly more complicated than that from a tax perspective. Or you can own a property in a tenant in common arrangement, which means that you own, like in my example here, you can have the husband owning 99% of the property, or you can have you can have it in any ownership ratio you want. So it could be 99-1, 75-25. It doesn't matter. But from what's interesting, the ownership is very much a legal concept. But when we talk about tax, when you're married, there are benefits and one of them is that you can shift the profits from the property in accordance with whatever ratios you want. So it doesn't necessarily matter if it's in a generally speaking, with 50-50 is the most common ownership ratio you have between spouses. But for tax purposes, that may be the legal understanding. However, you can deviate the profits in accordance with whatever ratio you want without changing the title deed. So in a nutshell, what that means is, let's say the husband in this example is a lower rate taxpayer and the wife is a higher rate taxpayer. Of course, it would make far more sense for the lower rate taxpayer to pay tax on the profits compared to the higher rate spouse who would pay a higher marginal rate. So just to give a bit of a flavor, I mean, that's sort of a very, very simple solution to a, you could instantly result in some tax savings there just by messing around with the ratios in accordance with how it's split, if there are variations in the profit, in the levels of income between husband and wife. So that's probably the most common one I come across. Another ownership structure maybe you are interested in would be a limited company. So this isn't necessarily something for everyone. In fact, I recently saw a graph which showed the sort of return, what level of income you would need from a property portfolio. So, 3 or more properties in order to achieve an overall tax savings from using a limited company. Of course, as everyone knows, limited companies pay lower rates of corporation tax. So corporation tax currently is up to 25%. Obviously, with income tax, you're looking at up to 45% if you're an additional rate taxpayer. Now, obviously, on the face of it, it looks like a clear win for a limited company. But bear in mind, of course, the tax take for a limited company is always at the point of distribution. So taking the profits out of the company. So you pay tax at the corporate level, and then you take the profits, whatever's left over, out. And then so again, in my example, let's say husband and wife owns 50-50 of the shares in the company. They can elect a dividend. Of course, they're going to pay dividend tax on that profit that they take out from the company. So what you see is that there's a 2-tier taxation to a limited company. So let's say you're, just to use an example, person A needs their property landlord who owns, say 10 properties, but they need all of the profits to sustain their lifestyle. Then of course it wouldn't make sense for them to do limited company, because if you're ripping all the money out of the company at the end of each month to sustain your lifestyle, of course you're looking at 25% in corporation tax at the corporate level, and then again up to 40% income tax on for dividends, or if they take a salary, up to 45% on the distributions from the company. So what that means is, effectively, it very much is a horses for courses approach. So if you can leave money on the table, so in my example, if you have, let's say, about £50,000 of profit derived from a property that's owned in a limited company, then if you can, in isolation, if you can leave profits in the company to sort of accumulate over time in a low tax environment, then it's absolutely worth your while to consider looking at the limited company. Where I see the misconception is that people want to use the company, but they also want to take their money out of the company. And I think in those cases, it's quite difficult to just justify using the company. So, of course, one of the advantages I'll talk a bit later about, as Chenji mentioned, with the pensions, of course, utilizing the pension in synergy with a limited company can be a good idea. But limited companies are just something that I think is probably one of the most misunderstood areas of property finance and tax. So not necessarily a great one-size-fits-all for everyone. So yes, they, on the face of it, lower corporation tax, mortgage interest as a deduction. So as any landlord knows, after 2017, you can no longer take your interest from your mortgage as a deduction against your profit. You now get a basic rate tax credit for the amount of interest you've paid in the year, which if you're a basic rate taxpayer, there's no difference. However, if you're a higher additional rate taxpayer, then there's a big difference there, up to 20-25% difference. So perhaps if you're more leveraged, then the limited company could still have some benefit there, but the accumulation mainly of income is the reason why you would want to consider this. Next, we're talking a bit about partnerships. Now, partnerships and joint ventures are more or less synonymous. So, for instance, if you are looking to enter into, one might say, well, what's the difference between obviously a partnership and husband and wife owning a property? Well, all partnerships, all properties owned between spouses are partnerships, but not all partnerships are the same. So if you are in a sort of joint venture arrangement with someone, perhaps maybe your brother or a friend, you're looking to develop property and share in the profits, then you will need a partnership deed in order to ascertain how the profits are going to be distributed and also how losses are distributed, because they do not necessarily need to be the same. So you can have a loss sharing ratio and you can have a profit sharing ratio. And all it means is partnerships are not the same. Although there is no two-tier taxation, partnerships do operate more or less in, they say, flow through in the business, which means that you are the profits you make are taxed at your personal level, but there's no corporation tax to pay. So if you are, let's say, husband and wife can form a partnership together. Of course, you just need the minimum criteria to form a partnership is that you need two people. So they can be married, they can be non-married, they can be related, non-related, it doesn't matter. And the point is that you will form a partnership. In a partnership vehicle, mortgage interest can be taken as a deduction. So that's the slight nuance there between, let's just say, husband and wife owned property in their own names. There was no partnership. Of course, they can still distribute the profits in accordance with whatever they want because they're married. So there's flexibility there, but they can't take the mortgage interest as a deduction. So this is quite a cheap and cheerful solution to, if you are highly leveraged and you want to start taking benefits from the interest deduction rather than taking the basic rate tax credit, which ordinarily is available. This is one good plan. And I mentioned there just about succession planning and potential to incorporate later on. What that means is obviously a partnership, there's a partnership deed. So it's a formal piece of paperwork that dictates what happens in the event a partner dies. So of course, if you are in business with your, let's say, a sibling or a friend, of course, you have no idea really what their will says, and nor is it really your business. But it would be useful to know, if you're going to enter into business with someone, that the assets that you're looking to co-invest in, say a property, are protected. So you don't just put all your skin in the game, and then if someone passes away or is incapacitated, then there's no say, you have no say over what happens. So you could end up doing business with your someone's ex-spouse, or you could end up with very weird outcomes. But the key thing is that, of course, you want to make sure all of these things, succession planning, are all dealt with in the partnership deed that you agree. And then the potential to incorporate later on, which I think is a very valuable tax relief, means that a partnership can roll up into a limited company. There's quite a few criteria for what that means. There's something called incorporation relief, which is mainly based on case law. I think, again, that's one that I see a lot in the press, a lot of misunderstanding about how that works. But in the whole, I think there is a potential there if you are interested in a limited company. However, you already own the assets. Of course, how do you get those properties into the company? Or you're going to have to perhaps consider doing a partnership in the interim to later then move it in. And the reason why you'll do that is, of course, stamp duty and capital gains. Property values generally increase over time, even if it's just inflationary. However, if you transfer that property into a company, of course, stamp duty on the market value of the property, not the mortgages, as well as then capital gains tax on the deemed market value could be at play. So you could be looking at a lot of tax to pay just to move property from your ownership into a company that you own 100% of, which materially seems to just be, trade in hands, but there could be a lot of tax at stake. And the last one I just want to talk about is trusts. And trusts, again, I think are a very, very valuable tool if done correctly. Trusts are kind of similar to what happened to mortgage interest back in sort of 2015 to 2017. There's been a lot of changes to trusts. And what that means is trusts are something that people seem to know is a buzzword that people know a lot about, but don't seem to necessarily understand what the tax implications of having a trust are. course, usually when we're talking about trusts, we're talking in the context of given to children or given to grandchildren, or maybe you're just protecting your assets from inheritance tax. So let's say you're in your 60s, you spent your entire life building up a property portfolio. Of course, you get to that retirement age, you start thinking about, well, if I want to derive an income, maybe you followed Chenji's sound advice and you've planned for your retirement accordingly, but then you're worried about what happens to your inheritance tax. And we'll talk a bit more about inheritance tax later on, but trusts can work. I think when you're a property landlord, the biggest issue you have with trusts, or with tax in general, is going to be inheritance tax when you die. Of course, trusts can't die, so trusts end up, they don't pay any inheritance tax on death of the settlor or anyone. However, there could be, as we'll discuss later on, potential inheritance tax due if they die within 7 years of making the gift. Trusts also have the right to accumulate income, and of course you retain control. So control is one of those key things for any succession planning, because if you're looking to give away assets to your children, or maybe your children are under the age of 18, you just want to make sure that there's safety and checks and balances, so that you don't effectively give the keys to the kingdom and the children can fritter away all the money that you've worked hard to earn. So trusts can work. I think the biggest mistake people make when looking at trusts is thinking that they are inheritance tax free, but that's no longer the case. I'm just I'll be remiss to mention ATED, which is, that's, again, I strongly urge anyone who's looking to consider, we're talking specifically about limited companies now. If you are invested into a company that invests into real estate, so you use the limited company route I showed earlier, you will be required to file ATED returns if you are in excess of the filing threshold, which is currently £500,000. So what that means is, even if you don't have any tax to pay, or perhaps you do have some tax to pay, there's a filing requirement there, and it doesn't quite run in accordance with the tax year. Obviously in the UK, our tax year ends on the 5th of April each year, whereas the ATED year has to be filed by the 30th of April. So not a lot of time to get your act together, but there's a lot of penalties if you don't file it. And of course, ATED currently, if you're renting out the property, you don't need to pay ATED. But if the property is vacant, or if it's a second home, or if it's your own home that's in the company, then ATED will be a consideration for everyone. I'm just going to pass back over to Chenji, but just before I do, just noticed a question in the chat about investing into real estate investment trusts from a tax perspective. I think that's a really, really good question there. I'll just quickly touch on that, because I think real estate investment trusts, one of the benefits, and we've at Fusion we've advised clients on setting up real estate investment trusts, or REITs, which you may have seen earlier. Effectively, the main benefit from a tax perspective is that real estate investment trusts don't pay any corporation tax. And what that means is that they effectively have one tier of taxation. So all the profits generated go to the shareholders, because effectively a company, even though it has the word trust in the name, it's slightly confusing. But the real estate investment trust has to withhold basic rate tax from the distribution. So effectively the tax gets withheld by the real estate investment trust, and shareholders claim it back and match it against the distributions they receive. So effectively there's only one level of taxation, and they're incredibly tax efficient, because obviously you can pull together quite a few properties in this company, and you get all of the benefits of mortgage interest deduction and all that sort of stuff. Of course, usually real estate investment trusts own things such as shopping malls, hotels. So that's a sort of really key piece of tax planning if you're in that sort of medium to large property portfolio investor. But Chenji, over to you.
Great. No, thank you, Henry, for really wide covering, structuring options for landlords. So again, kind of following that, once you've done the structuring, especially if you now set up a limited company, right, there's a lot of really tax efficient protections that's available for landlords. So in a limited, so again, most landlords will have some kind of mortgage and some kind of debt. And if something were to ever happen to them, be it illness or death, right, then they would leave the mortgage wouldn't just disappear, but it would then go towards obviously the rest of the family. And then if you do have a limited company, you can actually arrange life insurance that's paid for by the company, and you get tax deductions from, and your beneficiaries, who can be your family, your children, for example, will get the payout on death with zero tax. So it's actually one of the very few things you can actually get tax relief for that also gets paid out tax-free, and that's called the relevant life policy. So that really applies for limited company directors, right? So landlords will have incorporated their holdings into a limited company, as well as actually family investment companies. And it just, again, makes sense. If you do have the profit whereby you can actually pay for a insurance policy, it's pretty much a no-brainer to do this, because there are very few things in the UK you can actually pay for with tax deduction and then get the benefits tax-free as well. Now, Cayman insurance is something similar, but instead of the benefit being paid to the family member, it actually gets paid to the company. And now, usually this is used for, again, joint ventures or even family investment companies, whereby somebody, again, is too sick to either sick or unfortunately dies whilst working in the company. Then the company will actually itself get a sum to either pay off a certain loan, or to perhaps hire somebody else to take over the other person's duties for the company. A shareholder protection really applies to, again, limited companies who have multiple shareholders. These could be joint ventures, and it could be like, again, a family investment company as well, right? Whereby you just dictate a certain specific, sort of set of terms, whereby if something were to happen to one shareholder of the company, the other shareholder will actually get a sum of money to then pay off for those to buy the shares from the deceased shareholders' family. Because what often happens is, especially in joint ventures, or again, in businesses whereby multiple shareholders are involved in running a business, somebody dies, and their sort of next of kin don't really know how to operate the business in that case, but they do have the shares, but the remaining shareholders don't have the funds to actually buy those shares out from the next of kin. So it just creates a lot of friction, a lot of uncertainty. But with this type of protection policy, again, the remaining shareholders will have the money to actually pay out and buy back those shares from the deceased shareholders, family, or beneficiary. And lastly, again, just bearing in mind the time, just want to quickly mention whole of life insurance, and this ties in nicely with the end, the last topic, which is in succession and inheritance tax planning. So a lot of landlords, especially if you're relatively young, so anywhere between 40 and 65. You don't want to actually just start to plan for inheritance tax by giving away your properties or giving away any capital, because you're just not ready yet and you still need to enjoy the income from it. But you're also concerned that whatever you're building, all the property appreciations, all the growth, 40% of that is going to the government on your death. So that's when, again, a whole of life insurance can be really, really efficient. And essentially, it's a way for you to mitigate your future, to create a policy in place that when you die, that, a insurance policy will pay out the sum of the inheritance tax bill, right? No matter when you die. So as the name suggests, it's a whole of life, covers the whole of life. You could die tomorrow, you could die in 50 years, but that policy will have a value, which is the cover amount. And it just means that your inheritance tax liability, your projected liability, is covered whenever death may ensue. So this really applies for some of the relatively younger landlords out there, and then to always get a quote and see if that, again, it's appropriate and it's in the budget for the family's holistic financial and tax planning. Henry, you're the inheritance tax expert.
Well, yeah, I feel death and taxes are usually one and the same. So I'll quickly whisk through the inheritance tax key points. Some really great questions coming in as well. Amy, does the residential properties put into trust exempt from inheritance tax? We'll touch on that in a second, but I think it leads in nicely to what I'm going to talk about now. So in inheritance tax, there are 2 times you're going to pay inheritance tax, which sounds a little strange. You're going to either pay it in your lifetime or on death. So inheritance tax that most people talk about is death. And of course, when 40% inheritance tax is the headline rate. Of course, there are still other reliefs you could potentially benefit from, which we'll touch on in a bit. But business property relief is the most valuable piece of inheritance tax you can benefit from. What that means is effectively, if you are invested into a property or a company, it could benefit from this 100% or 50% relief. And there are some requirements that you need to meet in order to benefit from this generous relief. But this business property relief is going to be the most valuable piece of relief that anyone can benefit from. However, you get 100% business property relief only on a business or an interest in the business, so partnership, unquoted company shares. So, for instance, if you have a limited company, notice that we are talking about unquoted businesses. So, obviously, if you invest in Apple or something on the S&P 500, then you're going to find that that's not covered within that 100% BPR. You do for some types of assets. So, you, for instance, quoted company shares or securities. So, you can get 50% business property relief to some extent on land, machinery, plants, property. And effectively what that means is you're not getting the full 40% exempt. So you're not getting the full exemption in life or in death, but you can get a majority of that exempted, which is still very generous. But notice I say a business, most people don't know, but when you've invested into, let's say, a property in a company, that doesn't mean that's a business. However, you may have a business that is trading. So there's this idea of trading versus non-trading. Let's say you're a mechanic and you run for a limited company. Obviously, that business itself would be inherited 100% BPR. It's a qualifying business. So when you die, you don't pay any inheritance tax on your business. However, you may also want to invest into property and you want to do it for a company. If you start investing in your trading business into what's called investment class assets, so real estate, etc., then that could potentially taint the overall trading business. So what people do in this case, so there's no way around, there is no way, I mean, yes, you can have a portion of up to a certain percentage of the overall company value attributed to a piece of real estate. So let's say your company's worth £1 million. If you have, let's say, £10,000 worth of property in there, obviously that's not going to be a huge issue. But if you have 100,000 or potentially £500,000 of property, that's where you start to jeopardize the overall trading nature of a business. And that kind of sounds like minutiae detail, but what you'll find is that what we advise is that we're separating out the non-trading versus trading, because if you can't benefit from BPR, business property relief, from the properties, then you don't want it to ruin the trading aspects of your business. And we'll talk a little bit about how potentially it can work in synergy with trusts, but there are prohibited activities I've listed here. So securities, if you're trading, so effectively investments, land and building, obviously speculative investments, and basically anything to do with investments will not be covered under business property relief. And I'll touch in a second on the residential nil rate plan, but just to go back to Amy's question, so on the residential properties that are put into trust, so as we know now, you do not get business property relief on properties whatsoever, whether or not it's in your name, whether or not it's in a company name. The exception being, of course, if it's so let's say if it's like a hotel or if it's a trading property, so a furnished holiday let, potentially that could qualify. So if it kind of operates like a business, you may be able to qualify, but in the vast majority of cases, properties are not businesses. Even though they kind of operate like a business and you have to do a set of accounts each year, they're not one and the same. And what that means is when you put a property into a trust, as I mentioned earlier, there's the lifetime tax and the death tax. So of course, trusts never die. So trusts will never pay death tax. Of course, you can put property into a trust. The issue now is that you're going to have something called lifetime inheritance tax. Now that sounds kind of strange because why are you paying inheritance tax during your lifetime if you only pay it on death? Well, the reason is because you're putting the assets into trust. So there's a distinction here between putting something into a trust and giving it to someone directly. So obviously a trust, if you give it to, let's say, I gift my property to Chenji, of course, I don't necessarily pay, if I live 7 years, I'm not going to pay any inheritance tax. There's no immediate lifetime inheritance tax to pay. Obviously, it's given to Chenji. When eventually he passes away, then there's going to be an inheritance tax take at that point. So the logic is that at some point, inheritance tax will be paid at the death rate, which is 40%. With a trust, obviously, it's not that simple. The trust will ever pass away, so it will never pay death tax. So what that means is in life, you'll pay a 20% inheritance tax almost upfront for the benefit of putting it in that trust. So you pay 20% on the market value going in. Yes, you get some relief from your nil rate band, which we'll finish off the inheritance tax piece on. But what that means is that you do not benefit. The trust does have an inheritance tax immediate consequence, and then every 10 years, if it's something called a relevant property trust, which it will be, every 10 years, you're going to pay kind of like a wealth tax up to 6% on the value of those trust assets. So, and 6%, again, not to throw a lot of numbers at you, but if you multiply that over, of course, every 10 years, and you look at the average life expectancy of a human being, you'll find that it works out to be roughly about 40%. So trusts are not necessarily, and of course, there are reasons to use trusts other than inheritance tax, but I think the misconception is that people see trusts as a way of getting out of inheritance tax altogether, which is simply just not the case. I'll just whisk through this quickly. I'm conscious of time. Residential nil rate band. So nil rate band, most people know, you get an amount tax-free. You can effectively not, when you die, inheritance tax-free, you don't pay any tax on. There is also a residential nil rate band on top of that, which means that when you pass on your property, so right now you can pass, if you're married, up to £1 million onto your children, grandchildren, or great-grandchildren, etc. Note here that that doesn't include nieces or nephews or children of the grandchildren, cohabitee parents, partners, sorry. And the distinction there is that, of course, if you are planning your will or you're looking at your affairs, and of course you have about £1 million of net worth, so obviously usually most times the main home is the key valuable asset. So when that passes on, you need to consider where it goes, because that will obviously affect the amount of inheritance tax that's paid on death. And right now, of course, if your estate is in excess of £2 million at the time of your death, you start to lose this. So effectively, it's one of those, a bit like a personal allowance. So the more you earn, the more you lose. So effectively, the more tax you pay. So it's very key that if you are doing some estate planning, and we are looking at trusts, then we do also consider what the inheritance tax position, so your net worth, is going to be. So if we keep it below 2 million, you won't lose this residential nil rate band, which is quite a generous tax relief you could benefit from at the time of your death. Now we're going to move on to the Q&A, and I see there's been some good questions put in the chat. And I realized, Chenji, would you like to answer the question about SSAS, and then I'll continue to talk about inheritance tax?
Well, I think the slide didn't put up through, I think that's the, well, yeah. So setting up a SSAS, right? So again, it's a bit more complicated than setting up a SIPP or a personal pension, which usually is, again, you get some advice, professional advice to see what your personal situation is, and then setting up, again, very quickly, there's various providers out there that can then, by filing an application form, you can set up a SIPP, a personal pension, or occupational pension very, very quickly. With the SSAS, you actually have to apply to HMRC for approval. So you will get the advice first, why, and then how is a SSAS appropriate for you and your circumstances and your goals. And then once everything is established, then you essentially work with a SSAS provider, right, which is essentially going to be acting as trustees of the SSAS pension scheme, and whereby you will be the owner of, essentially. And then you make an application alongside the trustees to HMRC about setting up this SSAS. So you include all the members that are going to be in the SSAS. You include the business that's going to be the sponsoring employer of the SSAS, and And these days, it should take about 6 to 8 weeks for HMRC to approve this. Now, obviously, again, it could get delayed, and you may want to actually use the current tax years as allowance to make a pension contribution. In that case, it's actually also quite simple, because all you do is you make the pension contributions by opening up a SIPP or a personal pension ahead of the tax year in 5th of April 2024. And when the SSAS gets approved, you just make a simple transfer from your SIPP or a personal pension into the SSAS. And again, you get to then essentially keep this year's allowances and still have all that money in your SSAS when the SSAS has been approved and opened by HMRC. Good question.
Yeah, I saw a question here. Simon, I think I've answered this already, but just to clarify, IHT payable on a trust, holding investment property when a settlor dies. So it's a bit of a trick question. So obviously a trust will never pay death tax, so i.e. tax when someone dies, because provided the settlor, so when you give away an asset, if you die within 7 years, then of course the estate has to pay a certain amount of tax. It tails off, so after 4 years, it reduces by 20% and 20% again the year after. So effectively what happens is if you die in year number 6 after making a gift to a trust, obviously your inheritance tax on the estate is going to be quite small. So it depends on two things. One is obviously the inheritance tax that is paid on the way into the trust, because you won't pay 20%. Let's say if you pay the lifetime inheritance tax when you put it into a trust, pay the 20%, you don't then pay another 40%, so 60% in total, you only pay 40% overall. So you do get credit for the lifetime tax you pay, and also then it depends when the settlor dies. So if they live for more than 7 years, of course, the settlor is off the hook, provided the settlor can't benefit from the trust, which is effectively makes the trust moot for tax purposes. But I hope that answered that question, Simon. And another really good question here. UK resident going to move abroad during his or her retirement. I think this is a really good way to end it, because it just sort of, I think, hammers home the idea of property taxation in the UK. Will you continue to need to pay UK tax if you invest in UK assets? So, I mean, we'll just run with that example. Obviously, UK residents at the moment, you pay UK income tax, capital gains tax on your worldwide affairs. So it doesn't matter if you invest in Portugal, Spain, wherever. If you're a UK resident, usually you're going to pay UK income tax on that. Of course, there are double taxation agreements. So, for instance, in the UK, if you let's say you live in Spain and you invest in UK property, of course, the UK has what's called primary taxing rights, and then your country resident has secondary taxing rights. So no matter where you live in the world, whether or not it's the UK or elsewhere, you're always going to pay UK income tax on your UK profits from UK investment properties. Of course, if you're a non-UK resident and you invest in UK property, you pay UK income tax first, and then you get a credit. So let's say you live in a country with no income tax, or obviously a lot of our clients live in places like Dubai, so they pay no income tax on their local jurisdiction. So therefore, they only pay UK income tax on their UK profits. But it doesn't matter where you live in the world. So you can fully escape UK tax. But also then the inheritance tax is also an issue for individuals who want to invest in UK real estate. I think that's all of the questions that I can see, but obviously you'll have our contact details after the webinar, so do feel free to, if you want to have a chat and talk a bit more, always happy to do so. Appreciate it's a lot of information to cover, but I think we were about spot on for time.
Thank you, and happy holidays.
Thank you, everyone.